And you had you've also written another article. You're coming out with another article on the LIBOR.
Yes.
Okay, and just for those of us who don't know, let's say me, the LIBOR is what?
It's one of the reference rates that's used for loans around the world, including the United States. It's similar to the Fed funds rate, but it's typically used internationally. It's not U.S. specific, and it just stands for the London Interbank Offered Rate. And so it's used as a reference rate for approximately $10 trillion worth of loans and also $350 trillion worth of derivatives. So it's used to price those loans and derivatives and so on. So this piece that I wrote earlier this week is an update to an article that I wrote in Forbes 4 years ago.
Okay.
And 4 years ago, I was saying that the record low LIBOR rate, which I had a chart, and I showed circles around every time the LIBOR went really low and there was a relative trough in the LIBOR and held there for a few years, bubbles would form because it basically represents the cost of capital is very cheap. It shows there's a period of cheap credit, and it allows rapid credit growth and soaring asset prices during that time. And then when the LIBOR goes back up, and typically it goes back up and really trades in tandem with the Fed funds rate.
Okay.
When it goes back up, those bubbles pop. So you can actually see, I don't know if you go to realinvestmentadvice.com, it's several days ago, it's just called LIBOR Surge Will Help Pop the Global Bubble.
Yeah.
And you can see that chart where I showed the prior bubbles that occurred during those troughs. So
you're talking about the dot-com bubble?
Yes, the dot-com bubble is one of
the housing
them.
Bubble.
Yes, the
mid-housing bubble.
Yeah.
All that.
The mid-2000s, the European housing bubble as well as the U.S. housing bubble in the mid-2000s bubble also corresponded with that period of low LIBOR. Same thing with the Asian economic miracle and then eventual crisis of the mid-90s.
Yeah.
Same thing had occurred when those rates were very low. So what I was trying to say 4 years ago was that the LIBOR had never been this low for so long. So we basically had two records in terms of the actual how low it was and for how long. And my argument was that it's forming the everything bubble just because we've never had this much cheap credit for such a long period of time. So this bubble is going to be bigger than all the prior bubbles.
And that's the problem. When banks make it cheap to borrow money, people borrow more money.
Absolutely.
And it just came out that the IMF just came out and said that we had $164 trillion in global debt. And in Lance's article, and I guess are you also working on an article on this, or it was
I
just
covered it in one of my articles. I did discuss it. I just
talking about that. Yeah, the IMF. Yeah, they say that we have $164 trillion of debt. That's 225% over global GDP.
Right, exactly.
And how can that be sustained?
Well, it can't, but a lot of it has to do with because rates are so low, it created another borrowing binge. And my whole argument that I've been saying when I've been warning about this bubble for the last 5 or 6 years is that this debt boom is why we have a recovery in the first place. There would be no recovery without this debt boom, and that's why I'm trying to say it's unsustainable. And I actually coined a term to discuss this or to describe this phenomenon. I call it a bubble recovery or a bubble-driven economic recovery. And that if you look at the underlying growth engines that are driving the economy, they're all bubbles.
Right.
Driven by debt.
Something interesting that you said, too, that if the LIBOR goes up, it would help to puncture this particular bubble. And that kind of goes in parallel with what the New York Fed president said in a press conference in Madrid a couple of days ago, saying that the Fed needs to raise interest rates in order to puncture this stuff that's going on. It's the only way that's going to draw everything.
But you don't want it to pop, right? I mean, that's the problem. If you raise too fast, you're putting a needle in instead of like a slow drain of this bubble. You're at risk of just making it pop and explode.
But bubbles don't slowly drain.
Exactly. You can't taper a Ponzi scheme, as they say.
Yeah.
That's the problem is that, unfortunately, it's so unsustainable regardless of the situation that, you can't. Soft landings are extremely rare. I don't see there being a soft landing in this scenario. But that was the crux of my whole article, is that it was a follow-up to that article saying that LIBOR rates were so low and it was inflating a bubble. Well, now LIBOR is surging along with the Fed funds rate. And my whole point was it's just a matter of time before that really starts to bite and then eventually starts to pop those bubbles. Basically, you have these loans that you have floating interest rates that are based in LIBOR become more expensive. Same thing, too, like I said 4 years ago, 2/3 of all large-scale corporate borrowings in Asia are based on the LIBOR rate. So you have all this flurry of economic activity and borrowing that was based on record low LIBOR. And now this cheap credit is being removed, and it's just only a matter of time before it pops those bubbles.
Well, and the multi-trillion-dollar question is, and I doubt that you know this, nobody knows this, is when does that occur? When does that bubble pop?
I don't believe it's knowable to any human so far in advance. Like you'll start to see, when you start to see, let's say, the yield curve invert and you start to see certain sectors blow up, then you can get an idea that we're near. But it's impossible. I don't believe Janet Yellen knows. I don't believe
there's
Powell
always like
knows.
little signposts on like increase in delinquencies, which we are already seeing,
credit
and
spreads,
the yield curve and all of those.